Strait of Hormuz, a geopolitical reckoning. Rapid price declines signal heightened risk aversion amidst ongoing sanctions and geopolitical instability. The recent 9% plummet in oil prices, coupled with a significant rally on Wall Street, represents a complex and rapidly evolving situation directly linked to the reopening of the Strait of Hormuz.
This strategic waterway, critical for global oil trade, has been subject to escalating tensions stemming from the United States' continued imposition of sanctions against Iran and President Trump's steadfast declaration the blockade on Iranian shipping remains in effect, despite Iran's public announcement of its full operational status. This contradictory messaging has triggered a pronounced shift in market sentiment, with investors demonstrating heightened risk aversion and a scramble for safer assets.
The immediate impact reflects a substantial reassessment of supply chain vulnerabilities and underscores the profound influence of geopolitical factors on global commodity markets. Furthermore, the persistent uncertainty surrounding maritime security necessitates a careful evaluation of potential escalation scenarios and their attendant economic ramifications. The situation demands immediate attention from policymakers and financial institutions alike, requiring a comprehensive strategy to mitigate potential disruptions and safeguard economic stability.
Navigating turbulent waters, the Hormuz Strait's strategic significance. The reopening of the Strait of Hormuz represents a tactical maneuver, not a fundamental shift in geopolitical risk. The reported reopening of the Strait of Hormuz by Iran, coupled with the unwavering continuation of U.S. sanctions, presents a precarious situation characterized by a deliberate obfuscation of intentions.
While Iran's official statement indicates unrestricted access for commercial vessels, the United States' continued blockade, a critical element of its broader geopolitical strategy, introduces substantial ambiguity and underscores the inherent volatility of the region. Historically, the Strait has been a focal point for international tensions, primarily due to its strategic importance for global oil transit and the complex web of regional alliances.
The current dynamic is further complicated by the underlying drivers of conflict, including ongoing disputes over regional influence, the proliferation of non-state actors, and the potential for miscalculation. The market's reaction, a precipitous drop in oil prices followed by a Wall Street rally, indicates a recognition of the heightened risk associated with this volatile corridor, suggesting that the perceived threat to supply outweighs any immediate gains from Iranian cooperation.
Ultimately, the situation highlights the enduring influence of strategic competition and the potential for unforeseen events to disrupt global commerce.
Decoding the conflict, sanctions, blockades, and market reaction. The interplay of U.S. policy and Iranian actions is fueling unprecedented market volatility. The core of the current crisis lies in the fundamental divergence between Iranian declarations and the continued enforcement of U.S. sanctions, specifically the blockade of Iranian ports and shipping lanes.
This creates a state of perpetual uncertainty, prompting a cascade of reactions across multiple domains. Firstly, the U.S. maintains that the blockade, justified under the guise of preventing Iranian aggression and proliferation, remains in effect, despite Iran's assertions of operational freedom.
Secondly, the market's response to a significant drop in oil prices followed by a Wall Street rebound reveals a crucial dynamic. While the reopening of the Strait represents a tactical shift in Iranian behavior, the underlying strategic threat remains firmly entrenched. The geopolitical ramifications of this situation are magnified by the potential for escalation, with both the US and Iran possessing the capability to disrupt global trade flows.
Moreover, the perceived vulnerability of shipping routes necessitates a re-evaluation of insurance, rates and security protocols, impacting maritime trade across the Persian Gulf and adding further pressure to the global economy. The situation demands a nuanced understanding of the strategic motivations underpinning each actor's behavior, as well as a rigorous analysis of the potential consequences of further escalation.
Charting the future, risks, opportunities, and strategic imperatives. A protracted period of uncertainty will necessitate adaptive strategies and proactive risk management. Looking ahead, the situation surrounding the Strait of Hormuz presents a landscape fraught with both significant risks and potential opportunities for astute actors.
The most immediate danger remains the possibility of further escalation, potentially triggered by a miscalculation or a deliberate act of provocation, ultimately impacting global supply chains and driving up commodity prices. However, amidst this volatility, there exists an opportunity for nations capable of fostering dialogue and promoting stability to emerge as key mediators, potentially mitigating future conflicts.
Furthermore, companies operating in the region will need to implement robust risk management strategies, diversifying supply routes and investing in enhanced security measures to safeguard their operations. Crucially, policymakers must prioritize diplomatic engagement to de-escalate tensions and explore avenues for mutually beneficial cooperation.
The strategic imperative now lies in proactively assessing the evolving geopolitical landscape, anticipating potential disruptions, and developing adaptable responses. A commitment to long-term strategic planning is paramount to navigating this period of heightened uncertainty and ensuring continued access to vital global trade routes.